What's the real difference between a company that truly changes the world and one that just burns through a ton of cash and disappears? Well, it's not always about having the coolest idea or the latest tech. Today, we're going to pull back the curtain on the one number that really is the ultimate scorecard for any business. Let's dive in.
All right, let's go back in time. Picture this. It's the year 2000. The dot-com boom is absolutely raging. You've got these two companies that are the darlings of Wall Street. First, there's eBay, the online marketplace, valued at a mind-boggling $23 billion. And then you have Webvan, the online grocery delivery service with a massive $8 billion valuation. On paper, both look like they were going to own the future.
But wow, their paths could not have been more different. Just a couple of years after hitting that huge valuation, Webvan was bankrupt. Poof, gone. Meanwhile, eBay just kept chugging along, and by 2018, if you combined its value with its spin-off PayPal, you're looking at over $160 billion. I mean, what a crazy difference in outcome.
So you gotta ask, what happened here? They both had ideas that seemed revolutionary. They both had access to tons and tons of money. What was the secret ingredient that made one succeed beyond anyone's wildest dreams, while the other became one of the most famous flameouts in business history?
Well, the secret wasn't the idea itself. No, it was something deeper. It was the economic engine humming away under the hood. It all comes down to the business model, how a company actually works, and more importantly, how good it is at turning $1 of investment into more dollars of real profit.
And there's actually a name for this, a way to measure the horsepower of that engine. It's called return on invested capital, or ROIC for short. And it's a really simple question at its core. For every single dollar you plow into the business, whether it's for factories, software, or inventory, how much profit does that dollar spit back out every year?
Okay, so when you see the official formula, it can look a little intimidating. Kind of like something out of a finance textbook, right? But don't worry, we're going to ignore the jargon, because the actual idea behind it is incredibly simple. It really just comes down to two things: how much you make and how much you had to spend to make it.
Let's break it down into 3 easy-peasy steps. Step 1, how much cash do you actually make from selling something? That's your profit. Step 2, how much money did you have to spend and tie up just to be able to sell that thing in the first place? The warehouses, the trucks, all that stuff. And step 3, you just divide the profit by the investment. Boom. That's it. That's your return.
So now, let's go back and solve our big mystery. It all clicks into place, right? eBay was what we call asset light. It was basically just a website connecting people. It didn't need to own any stuff, so adding another million users cost them, well, pretty much nothing. That gave it an incredibly high ROIC. Webvan, on the other hand, was the total opposite. It was capital intensive to the extreme. It had to build giant, expensive warehouses and buy a whole fleet of trucks. Every new customer meant spending more money. Its engine was just super inefficient, which meant a terrible ROIC.
So as you can see, a high ROIC is way more than just a number on a spreadsheet. It's proof. It's a sign that a company has a real, lasting competitive advantage, which of course leads us to the next big question. So how do you actually build one? Where does this power come from?
Well, when you really dig into it, it turns out there are pretty much 2 main roads to a high ROIC. Path number 1, figure out how to charge more than your competitors. We'll call that a price premium. Path number 2, figure out how to run your business cheaper and with less stuff. That's cost and capital efficiency. And the truly legendary companies, they manage to do both. Let's talk about that price premium path first. And the perfect example, of course, is Apple. I mean, their entire strategy is built on making innovative products with incredible designs that are, and I'm quoting here, difficult to copy. And because of that uniqueness, they can charge a premium price, which leads to absolutely insane returns. Another way you can charge more? Sheer brand power. Just think about a company like Coca-Cola. The brand is so powerful and so ingrained in our minds that we're loyal and we're willing to pay more for it, even if a generic version is right next to it. That loyalty is so valuable that these big branded goods companies often see returns of around 30%.
And then there's a really clever one called customer lock-in. Gillette is the classic case study here. They practically give away the razor handle, right? Because they know the real money, the huge profit, is in selling you the replacement blades over and over again. Once you have their handle, you're locked into their system. It's brilliant.
All right, so that's charging more. What about the other path? Just being way more efficient. This is all about changing the rules of the game. Think about Dell back in the day.
They didn't have stores, they sold directly to you and built your computer after you paid for it. That meant they had almost no inventory sitting around, just insanely efficient. Same thing with IKEA. They made us do the assembly, and that completely flipped the high-cost furniture business on its head.
Okay, so we've seen how individual companies can build a powerful engine. But let's zoom out for a second. Does it matter what neighborhood you're operating in? In other words, does the industry itself make a difference?
Oh, you bet it does. Just look at this. This chart tells such a clear story. That steady high line up top, that's branded goods. Think things people buy over and over. Their brand loyalty makes it a structurally great business to be in. Now look at that crazy jagged line at the bottom. That's stuff like mining and oil, where you're just selling a commodity and prices go wild. The takeaway is simple. Some ponds are just better for fishing in than others.
But, and this is super important, your industry isn't your destiny. A truly great company can find a way to win anywhere. A superstar performer in a kind of boring industry can absolutely crush an average player in a supposedly hot industry. So strategy and execution still matter. A lot.
This brings us to the last and maybe the most important question of all. Once a company builds this amazing, high ROIC business, can they stay there? Or is it just a matter of time before the competition catches up and knocks them off their perch? Okay, this chart is honestly one of my favorites. It's so revealing. What you're seeing here is a study that tracked companies for 15 years based on how profitable they were at the start. And just look at that top line. Those are the superstars. And yeah, their returns fade a little bit over time, but look at how slowly. It's proof that a truly strong competitive advantage is incredibly durable. It sticks around for a long, long time. And check out these numbers. They're just wild. If you were a top-tier company back in 2007 with an ROIC over 25%, you had a 70% chance of still being a high-performing company a whole decade later. And get this, it works the other way too. If you were an underperformer, there was a 74% chance you were, well, still an underperformer 10 years later. The simple truth is, winners tend to keep on winning.
All right, so let's tie this all together. What are the big takeaways? 1. Return on invested capital is the ultimate scorecard for a business, period. 2. High ROIC comes from having a durable competitive advantage, which you get either by charging more or by being radically more efficient. And 3, and this might be the biggest one, these advantages are sticky. Great companies tend to stay great companies.
So I'll leave you with this challenge. The next time you look at any company, whether it's a hot new startup or an old giant, ask yourself, what does its economic engine really look like? Try to see past the hype and look for the ROIC. Is it a capital-light, high-return machine like eBay, or is it a capital-heavy beast like Webvan, just burning through cash? Because I promise, once you start using this ROIC lens, you'll start to see it absolutely everywhere.